What we know is a drop. What we don't know is the ocean.
Hello, and welcome to the Newton Knowledge Podcast. My name is Mark Singer, partner of Newton One Advisors, and I'm joined by our managing partner, Steve Target. The Newton Knowledge Podcast will provide meaningful content to our valued advisor community. Our discussions will deliver unique insights into the people, processes, and products that make our industry so critical. Newton One is a national life insurance planning firm delivering customized solutions structured to help clients and their advisors engaged in solving estate planning, wealth transfer, business succession, and executive benefits challenges. We are a member of the M Financial Group, which grants our clients access to the nation's elite carriers and exclusive products available only through our network. Today we're at Kreischer Miller, accounting, tax, and advisory firm focused on planning for privately held businesses, a leader in their practice located in the Lehigh Valley and Greater Philadelphia region, consulting for clients nationally. Today, we're with Brian Sharkey, director in charge of Kreischer Miller's transaction, advisory, and business valuation group, and Dan Cornell, director in their business valuations practice. Brian, can you share with us your career path and how you ended up leading your team's advisory and valuations practice?
Yeah, sure. So as I started at Kreischer Miller back in 2000, I was in the audit group. Did some taxes, did some employee benefit plan audits, did some non-for-profits, and over time, much like my self-proclaimed adult ADD would say, is I get bored of things, so I kind of move around, do different things, and then after so many years, I think I was a manager at one point, and I got an opportunity to bring in a client, and that client needed an audit, a corporate tax return, and a business valuation. So I went to the one partner that was here that had a business valuation background and appropriate credentials, and I said, "Hey, can you help me reel this in?" He did all the work to bring it in, and when he got in, I was like, I felt bad that I gave someone extra valuation work. I said, "Well, let me help you with it." And I'd say that was my primary gateway into the valuation, which kind of led to another special project, to another special project, to another special project. And over time, I do less and less of pure auditing these days, but more working with privately held business owners in the terms of whether it's a transition need, an exit planning need, an M&A need, or a valuation need is usually where I kind of help a lot of I'll say my clients, but really all the Kreischer Miller clients, and then any of the non-Kreischer Miller clients that need similar help.
Dan, can you share with us your 10 plus years of experience in the public accounting services industry?
Sure. So I started off at PwC doing audit for a Big Four firm, sort of did the obligatory few years in that and realized I did not want to spend my career in audit. Or at a Big Four firm, and left for a regional firm at the time called Friedman LLP, and joined a forensic litigation support and valuation services group. Stayed there for a number of years. They transitioned and went through a merger and became part of Markham LLP, which now has become part of CBIZ. During the midst of those transitions, I realized that I again wanted to sort of chase this size firm. I really like sort of the regional firm feeling and impact we could have with our clients, and found a great opportunity to come here to Kreischer Miller and joined up here sort of to take over valuation side of the practice and also work on building out a forensic and litigation support.
Beautiful. You are familiar with Kimberly Dula?
I am.
Freeman?
Very well, yeah.
Close friend of our firm. She's great. She was
Yes.
on the board of the estate. She was actually, I think, the president of the Estate Planning Council of Southern New Jersey for some time. And she had to pull a lot of strings in order to let me get in there. So.
Oh, she would do that. She's very nice. She's wonderful.
So let's start at the foundation. Or no, before we do that, we want to learn more about you guys personally. We'll put the professional stuff later to it as we get into those more detailed questions on, the services you provide here at Kreischer. But first, what activities make you lose track of time, and it can't be work related? Brian or Dan, whoever wants to go first.
I'll go first. My activity or activities that make me forget about work and much of life altogether is I like to either run or hike. So I'll do, maybe day hikes or, obviously maybe go for a long run, but I also do like maybe a 4 or 5 day hike where all you think about in that time is where you're putting your foot next. Wow. And that tree ahead of you. And I tell you, just every professional worry I have, which kind of evaporates for the time being. So it's a little bit of a happy place in my mind.
That's neat. I love it.
Yeah, for me, I would say it's hard because I have young kids to do something where I completely lose track of time. But once in a while, when I get the opportunity, I love to read and can easily lose track of time doing that. So science fiction, I recently was rereading the Dune books, getting ready for the third Dune movie to come out. So excited about that. And
I didn't know there was a third. So there's only 2 movies on, is it Netflix right now, I believe, or on something?
Yeah, there's 2 movies. They were, full theater releases. I think they are streaming on Netflix or Amazon, one of those. And there's a third coming. I think it won't be until 2026, but it's coming.
So did you see the movies?
I did.
What do you think after reading the book?
Oh, they're really good movies. Really good movies. But, I mean, like anything, nothing compares to the book. The book is just, there's so much more room for them to run with stuff. I think there's a lot missed still.
Yeah. Interesting. All right, so let's start at the foundation. How are estate taxes calculated, and what makes the calculation potentially more difficult for privately held business entities?
Yep. All right. So I'm going to try to keep this as simple as it is, because I love to oversimplify things. So hopefully I do a good enough job. Basically, when you pass away and an estate tax needs to be filed, it takes all of your assets, and those assets could be cash, investment, cars, houses, or stock in privately held company, adds up all the value of those things minus any liabilities you have, and that's the value of your estate. And if your estate is over set amount, which right now set amount is $14 million individually, if it's over that amount, you pay federal estate tax on that. So it adds up to $20 million, and let's say it's about $14 million right now. $6 million is subject to the tax, all right? And yet you asked the question, Mark, about, why is it tricky for privately held companies? And that's because, you think of the things I just discussed: cash, marketable securities, cars. Yeah, you can probably go an auto trader, and houses are pretty simple. But the value of a private held company is where it gets a little bit tricky, because what's a $20 million manufacturer, $20 million in revenue manufacturer? How much is that worth? There's a lot of things that go into valuing privately held stock, and that's the area gray. And for a lot of privately held business owners, it's their largest asset. Yeah. Is that value of that stock.
For valuations of estate planning purposes, they often are different from what the owner may expect in terms of valuating their business outright. Can you explain the difference that exists between what they think their personal estate may be and then what the actual valuation of the business is, and how discounting that essentially over time can come into play?
Sure. Yeah, absolutely. So as Brian was alluding to there a little bit, value is always sort of on a spectrum. Yeah, especially when you're dealing with something like a business. It's subjective and it's dependent upon the standard of value that you're considering. So a lot of times when you're thinking about value, people are thinking about the value of a company. If I sold it today, who would I sell it to? What would it sell for? But it's a little bit different when we're valuing something for estate tax purposes, and we're fully in this hypothetical realm, and within the definitions that are specific to standards of value for estate purposes. So Brian mentioned the house. That I think is kind of a great example to think about. If you were putting your house up for sale and you just put it out on the market and told people, throw me an offer, let's see what it's worth, you would get a lot of different offers in a whole range. And if you were actually selling your house, you would obviously take the highest one. None of the other offers matter. It's that highest offer. But I think when we're going through the subjective analysis of valuation, we would look at all of those offers and say, that's a market input as far as what this is worth. And it's the same with a business. We're pulling data from a lot of places, and it allows us to come to some place that's a little bit more towards the middle and a little bit more of an average, taking in a lot of market data. The second part of the difference is sort of standalone versus strategic value. So if you are really selling your business, you might be selling to a competitor who wants to, take over your customers, or another market participant who wants to enter your geographic area. And all of these things create strategic value, where there's value beyond just the numbers that we see and that we're not necessarily going to capture when we're valuing for estate purposes. So all of those things can drive the value up in a real market transaction, but won't necessarily get counted in our valuation techniques. And the last one you brought up, which is discounting, is really, really critical. That's sort of the last piece that comes in at the bottom. After we've done those other things that probably result in a middle to lower middle value range, then we're going to look at that value and we're going to say, well, it's going to take you quite a bit of time to sell that. It's different from owning shares of Microsoft or Apple that you can unload tomorrow. So there's a discount for lack of marketability that we can apply, and that's supported by valuation standards. And there's also can be discounts for lack of control if you're gifting a non-controlling interest, maybe to children, or separating interest between children. We can take an additional discount for a lack of control.
So let's dive a little bit deeper into the discounting aspect, and particularly related to privately owned businesses. What steps are necessary in order to gift or transfer shares of a privately held business so that discounting is helpful, discounting has an impact, and then when we look at the numbers long term, sometimes those assets that are transferred or gifted tend to be an incredible planning opportunity long term. So let's continue to unpack that a little bit. What are the steps? Why is that so powerful?
Well, the first step, and when it's effective estate planning, and you were referring to the gifting aspect of things, is the gifting now versus the estate tax later. So we talked a little bit of, I spoke a minute ago about how estate taxes work, but what we didn't talk about is the fact that when you gift, if I gift someone $1 million now, my $14 million that I mentioned earlier goes down to $13 million. So if I have $1 million of cash, and let's ignore all the limits today, and I gift it or I take it to my deathbed, it's the same answer because it didn't appreciate. That's where the privately held company and the steps that you're talking about are really critical here, is because if I have something that's highly appreciable, like privately held stock, and it's worth $1 million today, and it could be worth $2 million when I pass away. If I gift it today at $1 million, $1 million comes off of my estate tax bill potentially. Not my bill. That's probably a bad term, but it's off what's going to get taxed, right? But I saved myself that $1 million because it's highly appreciable. Now we take it one step further and we talk about the discounting. If I have $1 million of stock and I'm discounting, as Dan talked about it, now it's potentially worth $600,000. I used applicable discounts in order to, and I don't want to say artificially lower, because those discounts, as Dan described, they exist. It's real, and we need to factor that in for lack of marketability, lack of control. Whereas, just as Dan spoke, I could have stock that's worth $20 million today under Dan doing evaluation. And when I say Dan doing evaluation, he says it's worth $20 million, but I'm going to use discounts. I'm going to get that down to $15 million. But I know that I could probably sell it to that strategic third party for $40 million. So I just took $15 million of value. Let's say I gift it all away. Hypothetically, I gift it all away, and it turns into $40 million. Now I have bypassed, $25 million out of my state. You take $25 million and you multiply it by 40%. I'm not good enough to do the math fast enough, but if anyone's got a calculator, they're going to realize that's a lot of tax that was saved.
It's more than pennies underneath the chair.
It's a lot more than that.
So, and we also, all of us talk about, this planning has to happen sooner rather than later. We've got to get moving. We have to start thinking about it. From your perspective, how would you define sooner? Is sooner a year, 10 years, 3 years? I mean, what time frame? None of us answered this question, and if it's not one that you want to answer, but what time frame do you feel most comfortable with?
Now?
Like Brian said, because of the appreciable nature, you're almost always better off going as soon as you can, as soon as you can start making those moves to move it off of your estate and be able to get it out before it appreciates further. But to your point where I think you're getting at, as far as, can it be too late? There can be. We see clients come in where they already have that $40 million offer in hand and say, hey, I've got a $40 million offer. Now I want to do some estate planning. And we say, well, now we can't conclude to a $15 million value. You've got a signed LOI for $40 million. You're probably past that point. So it's earlier is better, and definitely earlier before you're going to have a real, transaction, and preferably significantly earlier. You don't want to also have a situation where we conclude to $15 million and 6 months later you sell for $40 million. That's going to draw some red flags, even if we did everything right and the $15 million is a reasonable and supportable conclusion at that time.
Yeah. And then there's the other practical matter of, I've got this asset. If it's not my asset anymore, that asset is generating revenue for me to continue my lifestyle. So sometimes there's that resistance with business owners or anybody that's gifting away their own assets. And clearly there's some point that everybody has that they need X, and anything maybe above X is giftable. But how do you work through, are there some other strategies with, let's just say, business owners or individuals for that matter, that can help alleviate some of those concerns about really giving away these assets, but then not having access to them? What sort of strategies would you at least throw on the table to consider?
Yeah, it's an excellent point. And I was working with someone a couple years ago, and he waited till his family was out of the room, and he turned to the attorney and I and said, I just don't want to ask for it back, because in some ways, we talked about how the stock in the company that he or she owns is their most significant asset, and it's probably how they get their income. So you're sitting down with them, you're talking to them about hey, what are your needs? A wealthy or business owner that might be in their 50s, that the timing is tricky there, is because you don't know what your retirement life looks like quite yet. The business owner that's in their 60s and 70s, you probably got a little more clarity. You're working with the wealth advisor, you're working with the other advisors to kind of figure out what their life needs, and then from there you're trying to determine, do they need value from the business, or do they need to start reducing their estate to avoid the tax? But besides there's the monetary aspects that you brought up, and there's also kind of the control aspects that you brought up that keeps people from pulling the trigger on this. I find that from the control aspect, that's easy. You can split stock in different ways, have voting and non-voting, and I've got some clients that have all the control but 1% of the ownership, because it's all the stock and all the vote. There's the one voting stock right there. That's it. That decides everything. And then 99% of the stock, the value is outside the estate. It's wonderful. Yeah. And we worked on planning. The other thing is trust. I think the younger you are, and it doesn't have to be younger, it could be anyone. The younger you are, the potentially you're able to use trust to kind of mitigate, getting assets too far out there. We could probably have a whole series of podcasts on the trusts that are out there and able to use them.
Yeah,
but there's the GRATs, there's the SLATs, the spousal lifetime annuity trust, which is basically swapping stock with your spouse and having access to each other's assets. So that's usually a really good way to do that. And then there's the other trust, and it's crazy, it's the defective trust, believe it or not. If anyone sells you on the defective trust, it's okay, hear them out. It doesn't sound as bad as it seems, but it's a great way to kind of manage cash flow, and also loans. You see folks with selling, doing some estate planning, gifting in conjunction with loans, and other mechanisms.
So as you guys know, one of our kind of core planning principles is, let's go on the record again. We sell life insurance. That's how we make a living. That's how we generate revenue for our firm. However, we prefer to come in with a life insurance recommendation after all of this planning is done. We don't want to lead with, hey, you should just buy this life insurance policy, because sometimes it's appropriate, sometimes it's not appropriate. Now, we've been doing this long enough that we know what strategies often are implemented, and we can help with the math. But A little bit of a lob question in our favor, perhaps. Do you see life insurance as a vehicle that can be helpful? I mean, is that something that you see in your practices as an opportunity to help mitigate some of those future estate taxes? And if so, maybe what are some of the ways that you've seen it work?
Yeah. You want to fill this first, Dan?
Yeah, absolutely. So we absolutely do see this. And, as far as mitigating the taxes, as you mentioned, and we were talking about trust, one of the great options is an irrevocable life insurance trust, which will move the value of that life insurance policy completely out of the estate. So it could, won't be included on that $14 million estate cap. It'll just be completely outside of the estate. Is a great way of, mitigating the exposure to estate taxes. I would also say sometimes when we're talking about transferring privately held companies, sometimes there's a child who's not going to be involved. Sometimes it makes sense to, from an equitable split standpoint, to assign value from a life insurance policy to a child who might not be active in the business and shouldn't have ownership, and it's simpler to split things that way. It also, just the liquidity that comes with a life insurance policy. A lot of times when someone dies, there is a lot of assets, but they are not liquid. And so having the liquidity that comes with a life insurance payout can make it a lot simpler.
Oh, absolutely.
Yeah, in my time, I've seen life insurance in every shape or form that is out there, and it really is. I think, and I'm not saying this because you guys are sitting across the table for it, but life insurance should always be included in the option, because sometimes they can fill in holes or come up with solutions that just typical, estate planning involves. It's kind of, filling those illiquid need, providing cash flow. I've seen it. It's just it's an option that needs to be explored in every scenario, in my opinion.
Just as you brought up the numerous amounts of trusts that are out there, you don't know which one you're going to use until you understand the makeup of the estate client. You talk slats. If they're not married, we're not talking slats. So just understanding the makeup is very similar to our approach. And are we talking survivorship planning, life insurance policy? Are we talking traditional term or universal variable life? You don't know until you know the makeup of the case. And I think that's why both of our firms, we're aligned in terms of those planning techniques. Is there anything we missed today? Is there anything else you want to share? We're coming up on our 25 minutes.
The only thing I just want to add, and it's kind of really piggybacking off of what you were just saying about how our firms are a little bit of aligned. It's whenever you're dealing with like estate planning, transition planning, exit planning, it's a multi-professional aspect. Yeah. You always need several different professional providers around the table, whether on the wealth side, the insurance side, the accounting side, the valuation side, the tax side, and obviously the attorneys. They're always needed to kind of button things up for everybody. But it is a multifaceted approach that just requires a lot of attention.
I couldn't agree more. Steve, you got anything?
Thanks for being with us.
Yeah,
Thank
appreciate
you.
it.
Thanks for coming.
Dan and Brian,
Really
Kreischer Miller.
appreciate
Yeah, thank you.
Bye. Goodbye.
The material and opinions voiced are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, please contact a member of our team.